Hi, I'm Dave DeTagios at SRP. Welcome to our quarterly market insights for the second quarter 2026. Today, I'm going to ask a few targeted questions and let our Chief Investment Officer, Bob Wagner, walk through what mattered this quarter, what we're watching next, and what it means for investors and committees. Bob, before we get into specific charts, can you give us a 30,000-foot view? What are the headwinds and tailwinds that are shaping the markets right now?
Yeah, this market's been basically doing what I call climbing a wall of worry. What's kind of interesting, you can see here that we have AI on both a headwind and a tailwind. Now, AI is going to be disruptive to some industries. It's going to put some people out of work, but it also can make people more productive and create new industries. So that's kind of the situation that's a big unknown. We have what's going on over in Iran. If it's over quickly, that should be a nice little tailwind. If it becomes a drawn out event, that could be a headwind. And then we have other things like the tax refunds and things like that. They're going to be hitting the market. So there's a whole bunch of things that are hitting the market, but it's going to be interesting to see how all these work together and shake out over time.
We'll get into the details, but which one of the variables do you think could change the outlook the fastest, Bob?
Oh, I definitely think it's Iran. I mean, we're probably going to know this within this next quarter. If that gets resolved quickly, I would expect oil prices to start falling, and the economy, the bull market that appears to already have started, will probably continue on and maybe even pick up steam.
Bob, one of the most interesting parts of this deck is what you call the tale of two CPIs. Can you explain what it means in plain English and why it matters?
Yeah, this is one of the more interesting economic stories. The CPI is basically a fixed basket of goods. Well, the problem is not everybody of all income levels buys that fixed basket of goods, and what they're buying takes up different percentages of their income. So as you can see on the chart to the far left, the top 10% of income earners, they're saving 26% of their income, right? So when you're saving a huge percentage of your income, price of eggs may not really be too big of be too impactful, right? Go over to the bottom 90% and you can see almost all of their money is being spent on goods and service spending. Go up and to your right, you can see that the bottom 20% is spending around 20% just on gasoline. Right now, throw on food and rent there, and you can see that's a relatively tight lifestyle. Go over the top 20% of earners, they may not even know what a gallon of gas goes for. Then if you go down to the bottom right, what you can see here is that if you put everything on a total basis, what you see is the bottom 20%, they are spending a greater percentage relative to their income than when you look at the top 20%. If you take a look at the top 20%, you can see that their pre-income tax percentage is exceeding what they're spending, meaning that they're basically saving a lot more than the bottom 20%. And you can imagine in that world why prices mean a lot more to the bottom 20% than they do to the top 20%.
Bob, you've said before that perception is reality. How does that gap between how inflation feels and what the data actually says show up in the markets?
Well, as we just covered in the previous slide about the tale of two CPIs, well, if you're one of the people that are really feeling the bite because of this affordability crisis, what that does is that bleeds over into your consumer sentiment. You're really struggling. You're holding back on spending all you can. You're shopping around. And what that does is that kind of creates a bearish sentiment for the markets. And as you can see in this chart, going back to 1971, we're near the bottom of that range. Now, historically, that's actually been kind of bullish, right? As you can see up there, you have 10 sentiment peaks. From the peaks, you made 4.8% going forward in the next 12 months, or you've had 9 troughs where the following 12 months has resulted in 24%. So when you take a look at this chart, we're at the area which has typically been a good launching pad for a bull market, but put in the current environment where you have a situation over Iran that can resolve positively, that could be almost a double whammy for a nice bullish settlement, building in the bullish settlement. So when I'm looking at this, I'm sitting there thinking this might actually be kind of positive, especially if things resolve positively over in Iran.
Bob, let's talk about what you call bull market fuel. What's the basic mechanism that investors should understand here?
Right. Well, we just covered one with the sentiment, right? When there's a lot of pessimism out there, that's typically a good time to buy. The old saying goes, you buy when blood's in the street, you sell when trumpets are sounding. The other thing that we look for, of course, is interest rates, and the interest rates bleed off of the CPI. So as oil prices have spiked, the CPI went higher, interest rates shifted higher. So what we have here are three charts for the yield curve. We have the top line is the post-war peak. We went to war, oil prices spiked, drove the CPI higher, interest rates spiked higher, right? The bottom line is where we were before the war started. And the middle line is where we are now. So what you see there is war caused the panic, it spiked, right? Then as things start to resolve over there and the price of oil starts to come down and the fear of inflation starts to come down, then the yield curve shifting down lower. Now, if we get things totally resolved overseas and when we get the yield curve to shift down to or below the pre-war levels, that's quite a bit of bull market fuel, because falling interest rates are typically very good for the markets, unless, of course, the falling interest rates are due to a recession, which we don't have.
And what's the bear case version of that story? What would need to go wrong?
Well, the bear case is things don't get resolved overseas, because we saw what caused the spike of interest rates was the price of oil and the uncertainty created by a war, right? Well, if this does turn into quote unquote a quagmire, and we see that the yield curve continues no longer shifting down, but decides to shift higher and actually breaks the previous peaks, I would imagine the markets will react relatively negative to that. So, I view the yield curve as kind of like the ultimate truth teller. And so I keep an eye on that. And right now I'm watching for the yield curve to keep shifting down. That'll keep me bullish. If I see this reverse and start heading north, that'll start turning me bearish.
Bob, you've said that geopolitical shocks tend to be shallow and short-lived from a market perspective. What's the practical takeaway for investors watching the headlines today?
Well, the practical is that they typically don't last long. And historically, they've been great buying opportunities. As you can see from this chart, during these crises, the median number of days for recovery is 12, which I think is pretty amazing. But as you can see, typically these events, they are disruptive. They get everybody concerned. They disrupt the yield curve. They disrupt the markets. But the market tends to look past them, and the markets tend to recover relatively quickly. So, when I'm looking at what's going on right now and the direction things are going, to me, it gives me a feel like this is probably a better buying opportunity, and certainly not the type of market I would want to be selling, unless, of course, we start to see things really break down with the yield curve, like as I pointed out.
Bob, looking at AI, we wanted to talk about whether it's an oasis or mirage. Does it have legs, or is it a temporary trend or fad?
Yeah, this is once again another one of those fascinating stories that's going on in the markets right now. The markets are trying to figure out, is AI the Cabbage Patch Kids, or is AI the iPhone, right? Because what's happened is the earnings of AI continue to go higher. But the problem is the stock prices have started to fall. Okay, now why does that happen? Well, it's because the markets have started to show that they're lacking confidence in the optimism built into this market, and you're getting what's called a multiple contraction. Earnings continue to go higher, but prices have fallen, so the PE, the contraction, has reduced. So as you can see up and to your left, the Mag 7 has been probably one of the worst performers in the markets. The S&P's down 5. The non-Mag 7 are only down 1, but the Mag 7 are down 7, right? So that's skepticism building into it. But if you go down to the bottom right, you can kind of see earnings continue to be very strong. Okay, and the PE, the earnings continue to go higher, but the numerator has continued to fall. Going over to the right chart, you can see the same story. Even with the strong earnings, the prices have been selling off. That's because the market's starting to lose confidence. It's starting to think maybe these are the Cabbage Patch, not the iPhone. So going forward, what we're going to have to see is, does the market regain confidence that AI is here to stay and this is a real game changer, or is this simply a passing fad? My bet is we're going to find out that this is a real game changer.
Bob, this is an interesting slide. We're talking about historical inflection points and where our current situation compares versus the past.
Yeah, if you take a look historically at the markets, there's been a few factors that will change, or what are called inflection points, that actually change the slope of the ascent of the markets. You know, if you take a look there, there's periods where you just go nowhere for decades or more, right? Then all of a sudden something will happen and it'll change the slope. Well, endings of wars tend to do that. Introduction of new technologies and industries will do that. And supply side economics like tax cuts, which are labeled by the green arrows at the bottom. Those tend to change the trajectory of the markets. Now, if you look at what's going on right now, we have basically three of those. We've just recently had a large tax cut. We're introducing AI, and we went to war in one of the most critical, economically critical areas of the world that hopefully will be resolved positively. Put all three of those together, and you've got a situation much like the ending of the Cold War, the fall of the Berlin Wall, where we could actually change the trajectory of the markets going forward. So once again, those are three really good bull market fuels that are occurring right now.
Bob, this is our last slide, and it piggybacks well off the prior slide in that how long can that line continue to go upward when we're talking about our current period versus history?
Yeah, now this slide comes from last quarter, and it kind of brings out the economics instructor or finance instructor in me, because I like to understand why things are going to happen. Well, what we just talked about there was a changing of trajectory. Well, if you think of the markets as a discounting mechanism, what's going on over in Iran right now can have a huge impact because it impacts all aspects of a dividend discount model. If we can bring a more safe and secure supply line for our oil and production over in the Middle East, that will lower the global risk premium. Well, if you have a reduced global risk premium, earnings become far more predictable and secure and reliable. Combined in tax cuts, your earnings are going to go higher. So the numerator is going higher. The discount rate, because we've got a lower global risk premium, that's going to go lower. So you're going to lower the denominator. So you boost the numerator, you lower the denominator. That's a double whammy for the price. So in this situation, if all goes well, we could once again have a inflection point, and once again, it's based on a dividend discount model. By reducing the risk premium of the globe, increasing earnings, all leads to higher prices.
Bob, thanks so much for that great perspective. Really appreciate it. If you'd like to talk about how these themes impact your plan, your portfolio, or your committee, your SRP advisor is always available. Thanks for watching, and we'll see you next quarter.